All right, so guys, this is episode 6 of our series. We're still continuing with our series. So now this is going to be a little bit mathematical, but yeah, like numbers rule the world. So cost mechanics. By mechanics, don't be scared by that. It's just the math, like how it moves. So we have the bid, we have the ask, they have the spread, P plot size. We shall be explaining that in a few. So what is bid? The bid is the price the broker pays to buy from you, and the ask is the price the broker sells to you. Hang in right there. About to explain. So the bid, this right here, is the price that the broker is paying to buy from you. So you literally, that's a price that you're selling the broker at, and then the broker is buying that, is selling to you, or you're buying from him, the ask price. So the difference between those two prices is what we call the spread. And the spread is it is existent on most brokers because these guys need to make money. Because man, I mean, you're a broker. I mean, you have to get some commission at some point. So these guys profit from spread. And yeah, they profit from spread basically. So as you can see, spread is equals to 2.0 pips. Like what are pips? So pip just stands for percentage in point. Oh yeah. So a pip is just a difference in price movement. For example, if price moved from like, are you seeing the difference here? The difference in the bid here and the ask, 8408 and 8500. When you do the math there, it's literally 2 pips. So 2 pips, this is a difference in price movement. Basically, that's it. It's the unit that we use to measure the difference in price movement. So a pip is the smallest standardized price move. Most pairs, 1 pip is literally 0.001. Those are 4 decimal places, but with an exclusion for JPY pairs. JPY pairs, 1 pip is literally 0.0, and those are 2 decimal places because that's how it's quoted. That's how the JPY is quoted. Yeah, as you continue further, you'll understand why they are quoted like that. But for now, basically that's the gist. So they are like, now for example, this is the forex market, but there are different assets or instruments which we shall be explaining in another video, because you may be there saying, am I only going to focus on the euro USD or what? I can see guys on gold and what. When you understand the mechanics here, the knowledge is basically the same to the side. Just go and apply that one. Later on, when you go into strategies and what, how to actually, the how, the only thing that deviates is the how, but the engagement is the same. The what, the who. It's basically the same. So, what is the lot size? A lot size is the size of your position, the size of your position that you want to, the size of your buy or your sell. So, we have a standard, a mini, and a micro. So, a standard is 1,000, 1,000, this 1,000, 100,000 units, which is equivalent to one lot like this. Then a mini is 0.1. That's a 0.1 lot size, which is 10,000 units, equivalent to $1 per pip. Then a micro is 1,000 units, which is 0.1 dollars per pip. Yeah. So basically, that's what lot size is. Yeah, you'll basically be seeing the 0.01, those things as we go on further. So, what is leverage and margin. Leverage and margin, controlling risk and position size. Controlling risk and position size. Leverage is borrowed capital that lets you control a larger position with a smaller deposit. So, what do we mean by borrowed capital? Like I said earlier on in other videos, borrowed capital, the one that lets you control a larger position. So, this leverage is basically given to you by your broker. So, your broker is going to give you a certain amount of money. It's not going to go into your account. It's just that when you're trading, the market sees that amount of money. So there's a ratio. Leverage is given in ratios. So I have a 1 to 100. Basically, what a 1 to 100 means that every dollar is equivalent to $100. So, like for example, here, $1 is equivalent to 100. So, $100 basically is equals to 10K. Basically, that's what leverage is. Then we have margin, the amount of your funds set aside and locked by the broker to open and maintain a leveraged position. So margin is the amount of money that is actually, you'd say, is required to open a position. Yeah, that's the amount of money that is required to open a position. Then we have free margin. Free margin is the amount of money that is independent from the position that you've just opened. Basically saying is the money that is left aside. So when you open a trade, the free margin is the one that is not affected by the trade. This one can absorb floating losses. Okay, it's affected by the trade, but I would say it's more of a, when you place a trade, the money that is left behind is what we call free margin. Then we have the margin level. Margin level is basically the margin, or you'd say the amount of money that we have right now over the used margin, the money that you've used to enter the trade times 100%. It's just an expression of the equity over the margin in percentage form. Yeah, basically that's it. So if basically now this is best explained in risk management and all that stuff. So if you have any other questions, be sure to comment down below so that we can explain further, or you know perhaps learn from you. So this has been it for this video. Thank you so much for looking in. Catch you up in the next one.